Okay, I mean, the headwinds are there, though, right? You've got supply concerns. You've got rising interest rates out of the Fed. I mean, this all affects the Singapore market.
Well, yes, indeed, I think we are all posing ourselves for a potential rise in interest rates. But I think it really depends on how you're managing your interest rate profile. In our case, all our assets are in Singapore and our borrowings are in Sing dollars. So we are all looking at where the direction of the Sing dollar interest rates are. At this moment in time, actually, when we speak to the banks, we are not seeing any impact on our portfolio. And in particular, we have 85% of our borrowings on a fixed rate basis. So they're all hedged fairly substantially. And the impact on any potential rise in interest rates shouldn't have a significant impact on our portfolio.
And Lynette, let's talk about your earnings here. Revenue's up, very good quarter in the second quarter. Do you expect those same drivers to essentially continue over the next few months or so? I mean, what are your targets for the third quarter? I mean, can we expect 100 million Sing dollars by year end?
That's a pretty good question. Well, we just sold 2 assets, and the idea is to reconstitute our portfolio, and we are planning to reinvest that into a better quality asset. So we sold the 2 assets at a cap rate of about 3.2%, and we are reinvesting that into a development that will yield potentially 5% per annum. This is a redevelopment of the Golden Shoe car park. And that is going to be a significant and landmark integrated development in the heart of the CBD. We're doing this with 2 best-in-class developers, Capitaland and Mitsubishi Estate. And we are holding 45% in this development. So with that, it should ride us through this upcycle in the market. If you look at the statistics, the rents in Singapore are bottoming out. In fact, some property consultants have already recorded an increase in rents. So we believe that with the completion being in the first half of 2021, it should position us very well to ride the upturn in the cycle. And there's also no new supply planned for that year. So, yes, all bodes well for us.
Yeah, and this recent aggressiveness when it comes to land bidding, I guess that is also a very good sign in terms of the uptick in the market, you know, especially by the time that 2021 rolls around and you're ready to open up the Golden Shoe car park.
Yeah, the advantage we have is that we did not have to competitively bid for this land. It is a redevelopment, but we had gone through a lot of time to negotiate with the government to allow us to actually intensify the land use. So from $161 million, that's actually it's $155 million, just the worth of the car park today. It should be worth at least 1.8 billion Sing dollars by the time it's completed. And that's just the development cost alone. So not considering the profits that we'll be making from this redevelopment. So I guess the advantage is we didn't have to bid for the land site. And we have seen very competitive prices being bidded at for sites which are very well located in Singapore. And this Golden Shoe car park sits in the heart of Raffles Place. And we believe there's really no other comparison. And it's directly accessible to the MRT stations or the subway stations with plenty of amenities. What is very important in Singapore is food. And we will have the food center, which is like a very affordable food that is part of this redevelopment. It is an existing hawker center in Singapore, which everyone is very passionate about, and we're going to bring it back into the new development.
Yeah, you're going to be very popular, no doubt about that.
I hope it's air-conditioned, though, because it's just too hot there in Singapore. One final note here. You've noted there's been a decline in rents, but the thing is you have some leases coming up. I would assume that's going to put some pressure on your income moving forward. How large a part of your portfolio or your assets is affected by that dynamic, that you won't be able to charge as much because rents have come down?
Well, we don't have a lot of leases expiring this year. We have anticipated that the pressure on rents will come, and that's why a few years ago we had already deliberately limited the number of leases expiring to this year as well as next year. The bulk of our leases, more than 25%, will expire in 2019. So we expect the market to have recovered by then, and therefore we should be able to reap the rewards quite significantly by then too.